All right, let's unpack this. We're talking about Bitcoin, an asset that's seen an incredible surge this year, pushing past, what, $108,000 and commanding a $2 trillion market cap.
Yeah, staggering numbers.
But with that kind of ascent, you also get, well, extreme volatility, the ripple effects of global geopolitics and those ever-present market cycles.
Totally. They're part of the package.
It leaves us all with that persistent multi-million-dollar question. Is now actually a good time to buy Bitcoin? To truly answer that, we're not just looking for a simple yes or no today. Our mission is really to cut through the noise, bypass the speculation, and embark on a deep dive into the very pulse of this market. We've gathered a substantial stack of research scientific studies, academic analyses, and solid market data to help you identify the most rational, evidence-based moments to maybe consider acquiring Bitcoin.
Yeah, moving beyond just gut feelings.
Exactly. We're dissecting its mechanics, charting its potential futures so you can make that call with hopefully real confidence.
And we're going to guide you through that journey. We'll start by grounding ourselves in Bitcoin's current landscape, where things stand right now.
Okay.
Then dive into crucial technical and fundamental indicators that kind of whisper or sometimes shout what's happening beneath the surface.
Right. Reading the signals.
Exactly. From there, we'll explore proven entry strategies that can help mitigate risk and even peek at potential, let's call them alternative scenarios, and risks that could unfold in late 2025 and into 2026.
Okay, so the what ifs.
Precisely. This isn't just about knowing what's happening. It's about understanding why it matters and what you can actually do with that knowledge as you navigate this often complex, but let's face it, undeniably compelling market.
All right, let's turn our attention then to the immediate landscape. What's Bitcoin's snapshot look like right now, say September 2025? Where are we standing at this very moment, according to the data?
So as of early September 2025, the picture is, well, quite compelling. Bitcoin's price is hovering around $108,000 USD. We actually just recorded in a new all-time high, 111,927 USD back on May 22nd of this year.
Not too long ago then.
No. And if you look at its short-term performance, it's pretty impressive. A 90-day return showing a gain of over 40%.
Wow, okay.
However, there's a curious detail that warrants attention. Daily trading volume is currently down by about 15% compared to the monthly average.
Interesting. Lower volume despite the gain.
Exactly. Now, this all takes place within a very specific and crucial context.
Yeah.
We are deep into what's known as an expansive post-halving cycle, following that significant supply-cutting event back in April 2024.
The halving, always key.
Absolutely key. This historical pattern is fundamental to interpreting future movements.
That's a fascinating mix, isn't it? Incredible gains, like you said, over 40% in 90 days, but then this noticeable dip in trading volume.
Yeah.
What does this immediate picture, this combination of soaring price and, well, quieter trading, tell us about the current health of the market as we search for that opportune moment to enter? Does the lower volume kind of temper the excitement of the gains?
It absolutely adds a layer of nuance, yeah.
Yeah.
And this is where technical indicators become, well, our best friends, offering deeper clues.
Right.
The research analyzed several key technical indicators, and they give us a much more detailed understanding of Bitcoin's position right now.
Okay, let's break those down.
Okay, first, the RSI, or Relative Strength Index, over 14 days. It's currently sitting around 38.
38, okay. What does that mean in plain English?
So an RSI typically signals if an asset is overbought, meaning too expensive too fast, or oversold, maybe undervalued. A value of 38 suggests Bitcoin is nearing an oversold zone.
Nearing, not quite there.
Nearing, yeah. It means it's not necessarily overheated and might have room to run, or is perhaps potentially undervalued in the short term.
Okay, what's next?
Second, the 50-day simple moving average, or SMA. Think of it as a shorter-term trend line. It's positioned at $106,412 USD.
And the price is above that now.
Yes, the fact that the current price is trading above this key average is generally seen as a bullish signal, indicating some upward momentum.
Got it. And the longer-term average?
That's the 200-day SMA, which is often viewed as a strong, longer-term support level. It sits lower at $102,100 USD. The price holding above that offers a kind of solid foundation.
Okay, so price is above both key averages.
Right.
What about the volume?
Right. Finally, as you pointed out, the volume is currently low. This is a critical detail. It points to what the analysis calls a lack of bullish confirmation.
Meaning?
Meaning the recent price surge isn't being backed by a high level of buying interest, like lots of people rushing in.
Okay, so the price went up, but not necessarily with overwhelming conviction.
That's a good way to put it. While it doesn't automatically mean a crash is imminent, it can hint at underlying instability or maybe just a lack of strong conviction behind the immediate upward move.
That's a lot of data points. If we try and pull them together, what's the sort of compelling story they tell about Bitcoin's immediate health and crucially about potential entry points for, our listeners? Like that RSI nearing oversold against a price that's still above the SMAs. How do those seemingly different signals harmonize into a single actionable takeaway?
Well, they harmonize to suggest something quite specific, actually. What the experts conclude from this combination is that Bitcoin is definitively not in an overbought zone.
Okay, not overheated.
Not overheated. In fact, if we were to see a correction, maybe a dip back towards the $105,000, $107,000 USD range,
Uh-huh.
that would, according to these technical readings, represent a potentially very attractive accumulation zone for new or existing investors.
Accumulation zone. Okay, so a potential buying opportunity on a dip.
Potentially, yes.
Yeah.
The lower volume suggests this current price action might not be as strongly supported as it seems, making any dip perhaps more of an opportunity rather than a cause for major alarm.
The charts paint a compelling picture, definitely. But let's maybe expand our lens beyond just the immediate numbers. What larger currents, the fundamental shifts in macroeconomic forces are truly shaping Bitcoin's trajectory in the coming months? Because as we know, it's rarely just about the lines on a chart, is it?
Absolutely not. It's a much bigger ecosystem. If we connect this technical picture to the bigger picture, we see a powerful confluence of supply and demand dynamics alongside these broader economic trends that are shaping Bitcoin's narrative right now.
Okay, like what?
First, the supply impact from the halving back in April 2024 is still very much playing out. This event literally cut the daily issuance of new Bitcoin in half, right?
Sure.
From 900 down to just 450 BTC per day.
A programmed supply shock.
Exactly. Historically, this dramatic reduction in new supply has fundamentally altered the supply-demand equation. It often kicks off a period where scarcity, combined with hopefully growing demand, propels prices higher.
And those peaks usually come later.
Typically, yes. These cyclical peaks often occur anywhere between 12 and 18 months after the halving event itself. So time-wise, we're right in that sweet spot of that historical window now.
Interesting. Okay, what else fundamentally?
Second, institutional demand. This isn't just a distant dream anymore. It's a real driving force in this cycle.
Yeah, the ETFs made a big splash.
Huge. Our sources highlight that Bitcoin ETFs in the US and Europe have collectively accumulated over 120,000 BTC in 2025 alone.
Wow.
This isn't just retail enthusiasm. This is substantial institutional capital entering the market, seeking exposure, and adding a whole new level of sustained demand that wasn't really there in previous cycles.
Okay, so supply down, institutional demand up.
Yeah.
Anything else?
And third, the broader macroeconomic narrative is playing a fascinating and sometimes a paradoxical role.
How so?
Well, while there's talk of a possible U.S. recession maybe predicted for 2026, the current strength of the U.S. dollar and, say, moderate inflation are, for many investors, ironically bolstering the narrative of Bitcoin as a store of value.
Like a digital gold.
Sort of, yeah. Or even a safe haven asset. In an uncertain world, some are increasingly turning to a digitally scarce asset as a potential hedge.
It's quite remarkable how these diverse elements, from a programmed immutable supply cut to these shifting global economic perceptions and institutional flows, converge to create such a compelling yet complex story for Bitcoin's long-term value.
It really is. It's truly an ecosystem of factors, all influencing each other in complex ways.
Given all this data and context, then, this layered understanding of Bitcoin's current state and its drivers, what's the playbook? How can someone approach buying Bitcoin intelligently and, with reduced risk? Our sources highlight several strategies backed by actual evidence, moving us beyond just gut feelings.
You're right. There are genuinely smart moves to be made here based on the data. The research details 3 key strategies that you could employ.
Okay.
The first, and arguably the most foundational for many, is dollar cost averaging, or DCA.
Ah, yes, DCA. Heard a lot about that.
You probably have. Studies from institutions like Coinbase and UC Berkeley consistently demonstrate that DCA is an incredibly effective method for reducing entry risk, especially with volatile assets like Bitcoin.
So how does it work practically?
The practical application is simple. You invest a fixed amount, say 100, maybe 500, whatever fits your budget on a regular schedule, maybe weekly or monthly. regardless of Bitcoin's price fluctuations.
So you buy whether the price is high or low.
Exactly. This consistent approach has actually outperformed trying to time the market, guessing the bottom in about 70% of cases over a 3-year period, according to the research.
Wow, 70%.
Yeah. It removes emotion and capitalizes on market dips automatically because your fixed amount buys more Bitcoin when the price is lower.
That makes a lot of sense. Okay, strategy number 2.
The second strategy involves buying in extreme fear zones. This relies on a popular indicator called the Fear and Greed Index, which basically measures market sentiment.
Okay, so buying when everyone else is panicking.
Pretty much. It's counterintuitive, isn't it? Most people panic sell. But in August 2025, for example, this index dropped to 28, signaling a period of extreme fear in the market.
And why is that a good time to buy?
Well, historically, periods marked by extreme fear have often coincided with local market bottoms, presenting potentially opportune buying moments for those, well, brave enough to go against the crowd.
Is there a recent example of that working?
Yeah, actually. The research points out that those who made purchases back in August 2025, when the index was low and Bitcoin's price was around $92,000 USD, would have seen a notable 17% return by September.
Okay, so DCA for consistency and maybe watching sentiment for opportunistic buys. What's the third one?
And finally, the third strategy involves riding post-halving cycles. This is based on that powerful, almost undeniable historical pattern we mentioned earlier.
Tied to the supply shock again.
Exactly. In all 3 previous halving cycles, 2012, 2016, and 2020, Bitcoin consistently reached its peak price somewhere between 12 and 18 months after the halving event.
And that's consistent across all cycles.
Remarkably consistent. It's often seen as the delayed effect of that supply shock meeting growing demand. If this powerful pattern repeats itself this time,
Which it might.
yeah. Our sources project that the current cycle's peak, following the April 2024 halving, could potentially occur between April and September 2025.
Right around now or very soon.
Yes, and with potential price targets ranging maybe from $150,000 up to $200,000 USD. Of course, those are just projections based on history.
So it sounds like maybe combining these strategies, consistent investing through DCA, maybe leveraging market sentiment during those extreme fear dips, and understanding these powerful, historically proven cycles offers a far more robust framework than relying on any single approach.
I think that's exactly right.
But for someone just starting out, maybe feeling a bit overwhelmed, is there one of these that serves as the most critical foundation to build upon?
For most people, DCA is probably the bedrock. It builds discipline. It removes the stress of trying to perfectly time the market. The other 2 strategies are perhaps complementary, offering opportunistic enhancements once that foundation is solidly in place.
Right. Start simple, then maybe add layers.
Exactly.
Yeah.
But now it raises an equally important question, doesn't it? What could potentially throw a wrench in these well-laid plans?
Oh, the risks.
Yeah. Right. No investment comes without risks, especially Bitcoin. And our sources outline several important alternative scenarios to consider for late 2025 and into 2026, so you can be mentally prepared for what might come.
Okay, let's hear the potential curveballs.
Let's run through them. First, a potential intensification of the Middle East conflict. The research assigns this a medium probability, but potentially a high impact.
High impact meaning a big price drop.
Potentially, yeah. Maybe a 30% fall in price. In such a scenario, the advised strategy is to, well, wait. Wait for confirmation of strong support, maybe around that $90,000 USD level, before making significant new entries. It's about not rushing into a potentially falling market.
Okay, caution in geopolitical turmoil. What's next?
Second, a global recession in 2026. This is seen as having a relatively high probability.
Yeah, lots of talk about that possibility.
And while it's expected to cause a temporary fall in prices, as investors typically de-risk across all asset classes during recessions, the recommended strategy is to stick with your disciplined DCA approach and, crucially, avoid panic selling.
Write it out.
Write it out, essentially,
Yeah.
knowing these are often temporary macro events.
Okay. Any potential positive surprises?
On the more positive, maybe less likely side, a Bitcoin ETF approval in China. There's even a low probability, but its impact could be immense.
Huge market potential there.
Exactly. It could trigger a significant, maybe 50% or more surge in price. If this unexpected catalyst were to actually occur, the strategy might be to consider an immediate partial entry to capitalize on that potential upside, as the market could react very, very swiftly.
Got it. And the last risk?
And finally, restrictive regulation in the EU or US. This is given a medium probability. New, harsh regulations could lead to maybe a 20% fall in price as markets react to increased uncertainty or hurdles.
So what's the advice there?
In that scenario, it's advised to review your overall portfolio allocation and, crucially, avoid using high leverage. Leverage can amplify losses dramatically in volatile, uncertain times.
That's a truly comprehensive look at the potential bumps in the road. Being prepared for these various outcomes, not just the rosy ones, provides you with a valuable framework for critical thinking, right, and decision-making.
Absolutely. It allows you to react thoughtfully rather than impulsively when things get choppy.
Gives you a roadmap for navigating that uncertainty. Okay, so after all that, what does this all boil down to for you, the informed investor, looking to make smart decisions in the Bitcoin market? How do we synthesize everything we've discussed into some clear, actionable recommendations?
Yeah, let's try and distill it. The core conclusions and actionable recommendations from our research are actually quite clear. First, and maybe most importantly, there isn't a single perfect moment to buy Bitcoin. That just doesn't exist.
The crystal ball is cloudy.
Always. But there are what the research calls probabilistically favorable moments, identifiable through this kind of detailed data analysis.
Okay, better odds, not guarantees.
Exactly. Second, the period of October 2025, basically, right now, is highlighted as a reasonable accumulation window.
Why now, specifically?
Well, it's supported by several factors we've discussed. The RSI being in that neutral to low zone, the price maintaining itself above those key moving averages, the post-halving cycle currently being in its historically expansive phase, and overall market sentiment not yet reaching those really euphoric levels, which can often signal a top.
Okay, a confluence of factors suggesting it's reasonable.
Reasonable, yes. Third, the most robust and recommended strategy, as we talked about, is likely a combination of consistent dollar cost averaging, DCA.
The bedrock.
Blending that long-term discipline with perhaps some opportunistic discretionary buying during significant market dips, specifically those greater than, say, 20%.
So DCA regularly, but maybe buy a bit extra on big drops.
That's the idea. It balances the power of consistency with seizing those short-term opportunities. Fourth, a reasonable price target range for Q4 2025 is projected maybe between $150,000 and $180,000 USD.
Based on historical cycles and current trends.
Correct. However, the report strongly cautions about the risk of an intermediate correction if that trading volume we mentioned doesn't pick up and confirm the upward movement. So volume is a key indicator to keep watching.
Right. Need that confirmation.
And finally, some crucial, just prudent investment advice that came through strongly. Always limit your Bitcoin investment to no more than, say, 5–10% of your total investment portfolio.
Keep it contained.
Keep it contained, manage your risk, and never engage with high leverage due to the asset's inherent volatility. That's not just a suggestion. It's emphasized as a fundamental risk management principle.
These are genuinely actionable insights, aren't they? Grounded in evidence and really designed to help you navigate this volatile but, potentially rewarding asset class with maybe greater confidence.
Hopefully, yes.
It's about making calculated moves rather than just jumping in blindly and really empowering yourself with knowledge. So this deep dive has offered a fantastic roadmap, outlining both opportunities and risks. But as we know, the world of Bitcoin never stands still, does it?
Never. It moves incredibly fast.
Our sources suggest some critical elements you should probably continue to keep an eye on, as they could truly shift the narrative going forward from here.
Absolutely. To stay truly informed and agile in this space, we'd recommend you continue to monitor the Fear and Greed Index weekly. What does it signal about collective investor psychology? Are we getting too greedy, too fearful? Watching that can give you a real pulse on the market sentiment.
Keep a finger on the pulse. What else?
Also, track the volume of institutional Bitcoin ETFs and maybe the movements of whales, those large holders, with over 1,000 BTC. Their activity, buying or selling, can often be a leading indicator of where the smart money might be heading.
See what the big players are doing.
Kind of, yeah. And critically, consider the implications. If Bitcoin's price were to close below $100,000 USD for, say, 3 consecutive days.
That 100K level is psychologically important.
Very. A sustained break below that, according to our sources, would be significant enough to require updating current projections. That would be a key point for reevaluation.
Okay, a potential warning sign.
Potentially. And finally, just general good practice. It's always wise to think about diversifying your crypto portfolio beyond just Bitcoin. maybe with assets like Ethereum or even stablecoins to help reduce overall portfolio volatility, especially given Bitcoin's inherent price swings.
Don't put all your crypto eggs in one basket.
Essentially, yes. Spread the risk.
These are great ongoing questions and data points for you to ponder and explore as you continue your journey to stay well-informed in this really dynamic space. Thank you for joining us on this deep dive into Bitcoin today.
My pleasure.
We really hope it's giving you some valuable insights to consider for your own informed decision-making.